This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe, and what I'm doing today is talking about long-term ETF investing for retirement planning. All right. Now, I tried to keep this shorter, and it's just not going to be possible. There's too much information. I need to go back through some of the history to give you enough examples so you have a better idea. I'm trying to give you ideas of when the timing is optimum. All right. When you want to really plunge down, if you have cash, put it to work. And when maybe to avoid being more aggressive adding, if you have money coming in and you want to put it towards retirement planning and the timing just might not be right. I want to show you the times to kind of sit back and look to take advantage. The other thing I want to do is what we're trying to do is avoid the big drops. And so I'm going to go through a few examples of how you can go about doing that, which time frames we would be focused on for that. And I think this will be helpful, but obviously you can give me some feedback on that. Now, a lot of these, the stuff I'm going to talk about is actually covered in the course. It's just I'm doing it from a slightly longer term standpoint. If you have any interest, you can go look at rabilstockresearch.com/books for more information. Also, if you do enjoy the content, please hit that like button and also subscribe. Okay, so as I start this process, I really think it's invaluable to look back historically speaking. And I'm using a monthly chart because I wanted to show that typically a monthly chart is about as long of a time frame that I really want to use. But you can see what's taken place, especially since 2010. We've had a lot of, look at the breaks of the 18-month. Look at how violent these moves are, turn down the 18-month, right? And so, and then you can see in 2000 and 2007, 2008, these are really what we're trying to avoid. From what I've seen, for people who are looking to do longer term investment, what scares them is buying here and then having to live through something like this, a 2 to 3 year bear market that really hurts. And this actually was pretty violent as well. It just happened very, very quickly. These are the ones that I think from a psychological standpoint really cause some pain. All right. So ideally, we'd like to avoid these. All right. And so I want to talk about a couple of things that we can do that will help. But the most important thing I want to get across is when I look at this time frame, and I can go back. I've got a lot of history here going back to the 30s, but it is very difficult to find entry points using the monthly chart. I don't see the signals. Now, I can see them as a lower time frame, but not as an upper time frame. So if I switch this to a quarterly chart, all right, now what we want to do is take a hard look and look at the way anyone who has any idea of how to use my approach, you can see the shift that takes place here with the zero line cross and then the pinch. And then we get another pinch here close to the 18 on the quarterly, another pullback here. And now all of a sudden the 2020 bear market looks like a pullback in an ongoing trend, right? We didn't even switch didn't even break the signal line. And look at the ADX pattern. You see how strong this is? So we want to keep an eye out for the quarterly when we're doing long-term ETF investing. This is for when someone, especially if someone's using this for retirement, this is the approach that I would use. So the way I would look at it, and one of the things I wanted to bring up is if you're 40 years old or younger, all right, then you don't really need to be too picky. You can do the buy and hold strategy and you could dollar cost your way in because you have plenty of time. I mean, let's say you're going to retire at 65. Okay. You've got 25 years. At 25 years, you could buy at any point in these charts. You could have bad timing. As long as you continue to buy, then you're going to be fine after a 25-year period. Now, once you get to 50, I think it gets a little bit more difficult because you could buy at the wrong period. And I'll show you an exact example of this. If you bought at the top in the 28, 29 period, it took you 25 years to get your money back. All right. So if you're retiring 20 here, you're still down. All right. Now, if you're dollar cost averaging your way through, you probably, as you came back up here, it probably didn't take you that long to get your money back. So you could probably pull it back through, pull it off through 50. The age of 50. But once you get older than that, and a lot of the guys that I talk to that are worried about, putting money away and just buying and forgetting about it, it's the guys that are over 50. And I agree with them. I don't think it's as simple as just putting the money away and forgetting about it. Now, I'm also not suggesting you do this with all your money. I'm talking specifically about IRA money that is very much expected to be used for retirement. All right. Something that you're not going to get to till you're in your 60s. So if it's in a 401k, if it's in, otherwise you'd pay a penalty, right? So either an IRA or a 401k, and you're looking at it much longer term. So those are the kinds of things that I think you want to be thinking about. Know what your age is, and then you also want to know what your kind of risk tolerance is, because that's going to help you decide how to handle some of these strategies that I'm going to give you during this video. All right. So let's start digging into this a little bit. And what I want to do, I do want to explain, look at the way things played out on a quarterly chart and how powerful the ADX signals were. All right. We made a top in 29 and we go through this long low ADX period. You see this low ADX signal? Look at there was some volatility, and that's what you'd expect in this situation. But look at this long period of, 15, 20 years where you have a low ADX condition, and then it kicks off and you start to turn things back to the upside. You break out, and then you actually get the higher low. ADX starts to kick into gear. Look at what followed. You see the movement? And then look at how this played out. You see how ADX confirmed, and then you got up into this region up here, and we started to fail to confirm. And then look at the size of the volatility. This was the start of the 70s. Let me just show you this. 70s, where we basically went sideways for about 10 years, okay? And then look at the way this played out. So we got this low ADX condition, tried to make another new high, low ADX, ADX did not confirm. And then we went through a sideways period. Again, it was about 5 years in length. And this turned into a low ADX pattern. All right. And then we broke out from that, made the higher low, got confirmation. And this is kind of another really good opportunity looking at this chart. So we can see the breakout pattern here. We can see the higher low forming here. And these are all being confirmed by what's happening on an ADX basis. All right. As we keep moving forward, we had a phenomenal period of continuation to the upside. Now, we have these opportunities near the quarterly 18. This is where we want to try and take advantage. When we get a breakout from a low ADX pattern and, make that higher low, we want to be looking to take advantage of those pinch plays on a quarterly chart. This is for long-term ETF investing. This is where you're going to have your antenna up saying, I'm looking to buy the 87 crash. All of a sudden, the 87 crash looks like a pullback to rising moving averages with a pinch play and very strong momentum condition in place. All right. Now, I'm going to go into a little bit more detail on these as we move on, but I wanted to just get this across. Look at how powerful this specific moving average is. Now, look at what took place from 95 to 2000. You did not get anywhere near the 18 on the quarterly for pretty much the entire run there. So we knew it was getting pretty extended because we altered, you see the aggressive nature of the slope. So we need to be aware of that as well. All right. Now, what the point I would make here is that we didn't get a really blatant, see how we had the blatant divergence here with the ADX, but we didn't have that happen at the peak here. We made a divergent peak, but we did have a contraction phase starting. You see how the sellers started to show up finally? after, again, about a 5 to 10 year run. So we want to be aware of what's going on with the DIs on the quarterly chart. In this case, it would have been telling us, to be a little bit more careful at this point. Now, I'm going to give a little bit more detail into the strategies. I just want to go through and just show you how the signals on the quarterly were actually very powerful. So we had this move to the downside. We came down, and then we actually came all the way back up to the high. But look at what happened. We had another divergence here. Now, I'm going to show you ways to be able to take advantage of these lows. But I wanted to just point out, when we get back up to this high, we make a marginal new high, and the ADX cannot confirm. We know that that's a troubling sign. All right, that's not what we want to see. We know this because we've been studying this ADX for a while. Then we get going again, and then we've had this run now where we have opportunity, 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 opportunity. These are all opportunities to be buyers as a long-term ETF player. Long-term, I'm looking to play, and I'm using the SPX as an example. You could do this with the spider. The reason I'm using the SPX is because it has a lot more history. All right, but you could do it with the spider. You could do it with any real. In fact, let's just go through a couple. We can look at the. Let's look at the XLV. Just to give you a completely different look, right? Look at the 18-month. The 18 on the quarterly, and look at the opportunities as we pull back towards that line. You see how this is in a big uptrend, and we're looking for opportunity. These are the best buying opportunities after we've worked our way back towards this line. All right, that is sloped upward. Let's just pick out something like the quarterly line. The XLI. So again, we make the turn, we get a move here, we get a pretty good indication here, and we had a really violent drop in the industrial space in the 2020 market decline. But it did get back up and going pretty quickly. So in this case, I wouldn't really consider, it wasn't a true break of the 18 on the quarterly, but it also wasn't a very good signal. But this was a really good signal. So you can start to see this in a number of different ETFs. Here's another pullback here, and we got going, then had another opportunity here, all with the moving averages still rising and good momentum conditions in place. All right. So I just wanted to point that out. All right, let's go back to the S&P. And what I want to do is switch this now to multiple time frames. And in fact, what I'm going to do is go back to the top in 2000. All right, because that's what I'm showing on the weekly here. Let me just get this weekly at the monthly here. And I've already got the weekly at the top in 2000. I'm going to go through a couple of these examples. All right, so we're making this move to the upside, but we're not checking back to the quarterly. All right, we did pull back to the monthly, and the momentum was pretty good through 99, and really it wasn't that bad. We were getting a little bit of contraction taking place, in this drop in 98, but then we moved to a new high, and then in this region, the MACD is not confirming as we flip over into 99, and look at what happened to the ADX on the weekly. All right, so we're making this move up into this big. This huge move in 99, and yet the ADX is really not confirming here. All right, we're really stretched away from this time frame. So what I would tell you is the strategy I would use is that I'm willing to buy a pullback to the quarterly line, or in certain cases the monthly line when we have good momentum in place. But as we get stretched away, and the longer this goes, if there's non-confirmation on either the monthly or the weekly, all right, then I don't want to be adding. I don't want to be buying any pullback or any retracement, or I don't want looking to buy pullbacks to the monthly line anymore. All right. So what we're trying to do is avoid adding once we get too stretched away. I mean, once this starts to get too stretched away, we want to try and avoid. However, if the momentum is strong and powerful, then we can keep adding on pullbacks. We would just have to use the pullback to the 18-month. So what I'm telling you is that we're using the same strategies that we use in trading, using trading stocks. We're using the same thing, only we're using it at a much higher time frames. When we're looking for opportunities, the best opportunities are at the quarterly line. Let's move forward, and I want to explain what you're looking for. So in this case, we didn't have divergence on the monthly time frame, but we got divergence on the quarterly as it moved up, did not confirm, and we got it on the weekly failure at a new high right before this peaked in 2007. All right. So we got to keep an eye out for this 80x exhaustion pattern in all three time frames as we're moving up. All right. When that happens, we want to be a little bit more defensive. Okay. We're looking for a break of the 18-month to kind of trigger us to reduce our size. So if we've been in this for a long time and we're moving up, and we want to reduce the size of our ETF, reduce our risk, then we would use the 18-month. With divergence taking place here, we'd wait for a break of the 18-month line, and that would basically tell us when we want to be out for. And what I would tell you is, depending on your age again. So again, if you're under 40, you might be reducing the position size by 50%. All right. Or maybe even less, maybe only by a quarter or a third. If you get up to 50, you want to probably be reducing by at least 50%. All right. If you're at 60, then it should probably be 75%, or it could be even higher. This is all personal preference at this point, right? If you're 60 or higher, you might want to reduce the entire position and cut it completely out. All right. I'm going to give you a few strategies for how to get back in, but where it gets, I think, really important is, again, this cutoff line above 50. Once you get older than 50, I think you got to start taking these signals a lot more seriously, because if you have to live through one of these, it's going to take you a long time to get your money back. It's hard to make plans for retirement if you don't know how much money you're going to have, because you're making a big drop like this. All right. So we want to avoid those. The 18-month is probably your best bet, following exhaustion. All right, we're going to look for exhaustion on the weekly, exhaustion on the monthly, or in this case, it was exhaustion in two different time frames. All right, let's keep moving forward. I want to show the bottom. All right, we make this huge move to the downside. We're plummeting to the downside, aren't we? Look at this undercut of this low from 2002, 2003, right? We're dropping down well below the 18-month line. Now, if we look at what happened on the weekly chart, we had plunged to the downside. We were showing good momentum characteristics on an ADX basis, but we get a MACD divergence in this case. It's not exhaustion. It's actually it's an exclamation point, a climax is what it is. Look at the size of these. So you're getting these decline moves, right? I'm sorry, decline, and then you get a decline, and these are not really that strong a reading. And then all of a sudden you get this move to the downside and this explodes. So you got to sort of, anytime that happens with the stock or any kind of market, you got to be thinking climax. So we get signs of a climax, and then we get a divergence signal here. Now, I remember this very clearly. I was sending out reports at this time, and I was highlighting, I probably sent out, I don't know, there were so many large cap stocks that were making massive MACD divergences here, and I was sending out lists. It was just a phenomenal opportunity. If you knew that you were stretched away here, you were undercutting this low, but we were getting signs that the momentum was slowing on the weekly. So if we're going to take advantage of big drops on the quarterly chart, we're not going to be able to find divergence on the next time frame down, but we have the ability to use the weekly. All right. This will hold true for pullback patterns too. So let me give you an example. Let's look at the 2020 drop. I think this is kind of important. So we go to the 2020 drop. Do you see how we just basically just dropped straight down? If we look at it on the weekly, this happened vertical down, vertical up, vertical down, vertical up, right? And then a vertical down. What it looked like a really good opportunity, but what we're going to need to do in this situation is take a hard look at the sentiment, okay? In this case, the sentiment here in 2020 was plummeting down below zero. So when you're in a bear market, we're looking to be buyers in ETFs below. Now, these are, I don't think these are considered bear markets at this point. You see what I mean? And you got to be dropping down. You've got to be down. So this was early, and it wasn't necessarily a confirmed bear market at that point. But we got real, I mean, this was the biggest reading we ever had in the 2008 and 2009. And we actually not only broke the quarterly line, but we actually broke the yearly line at that point. But that was the undercut pattern, all right? So what I'm trying to tell you is be on the lookout in a bear market for where we're below zero in the sentiment. When the sentiment, I talk about this every Friday, when we get down under, that's where you want to be buyers. If you're sitting at the quarterly 18 and you're below zero, meaning there's more bears than bulls, then you can start to do some buying. And what you'd probably do is start out with about a third or a half of what we want to buy. Just nibble, get in there and do a little bit of buying. This is the strategy that I use. I have a heightened awareness of where people are just throwing in the towel. All right. I am a big contrarian. Be on the lookout for these contrarian signals in bear markets. We want to look for where everybody is essentially puking it out. We want to see where, a client I used to call it filling their diaper, where everybody is filling their diapers. They're really scared by the market and they don't want to have anything to do with it. That's where you want to be aggressive. And if I get anything across on this, I want you to really be thinking that way. If you're thinking that way at the quarterly line, even on a break of the quarterly line, if you've got trend in your favor, and you've got sentiment in your favor, you can be a lot more aggressive during those periods. You're going to be fine. Even if it takes a little bit of time to turn things around, you're still buying at a much better point than you are when there's euphoria, right? When there's greed. And I'm not saying we're there right now, because we can see when we look at where we are right this second. Now, let me just pull up one more example. We can see this last pullback to the quarterly line during this bear market. This is a strong bear market to the downside. We were down a good 30, 40, 50% off the high, right? Look at the moving averages on the quarterly line. Look at how we still have good momentum. You see how this still has good momentum? There's no sign of divergence there. And then we come down to the 40, and MACD is actually coming back down to the zero line, and we get a divergence signal in MACD here. Do you see what I mean? Again, I would consider this more of a climax sign in the ADX, but we get the divergence here, and we're sitting at the quarterly line. So this is, again, if you're using this strategy, we're looking at a big negative. And when it comes to the bulls minus the bears, there's a negative sentiment reading, meaning people are very bearish. We're sitting on a rising moving average. We still have good momentum based on the ADX. We're coming back to the 40-month moving average, but more importantly to me is that we're holding the zero line in the MACD, and we don't see a lot of strength in the sellers at this point, despite the fact that we're down almost, I don't know, what is that, 25% off the high at this point. And we're not really, we've broken the 18-month, but we haven't really seen any real strength in the sellers there. So we can go, if that's the case, then we can go looking for divergence on the next lower time frame. We get that, and that actually ends up being a pretty good spot. Now, you don't have to be a hero like that. You can wait for a sign for things to be shifting back up. One of the things I would tell you is a trigger, as a pretty clean trigger. Let me do this real quick just to show you this. Is using the 40 week, all right? More like a trigger to get back in. So if things kind of roll down, we don't necessarily want to use an 18. we want to use the 40 and get that 40 kind of turning back around. That is a better entry strategy, and I think it will help you a lot more in these times. Now, because this was such a V-bottom type of a scenario, if you didn't catch the sentiment reversal, then you had to kind of wait a little while. But remember, we're trying to avoid the declines. We're trying to avoid these. This is what we're trying to avoid. You see this decline? You see how it stayed below the 40 the entire period? We can go back here. We stayed below. For much of it, it tried to break above it here, but if you notice, you never took out the high of the bar that closed above it, and it was actually a double top, and this was still declining. Then we finally turned the corner here by getting back above the 40. So it's a good, I think, a good strategy to use that 40 as much as you can as sort of a trigger to get you back in when you're interested in buying at the quarterly line. All right, that's a good strategy. 40-week combined with the 18 on the quarterly, right? Quarterly pullback, 40 as a trigger on a weekly, as long as we don't have a lot of violence on the monthly chart. Meaning if we have a lot of violence and the momentum is really, really bearish on the monthly chart, then we don't necessarily want to go diving in until that subsides on the quarterly. So I'm giving you some, hopefully, some of this gets across. I know this video was a lot longer than maybe we were looking for. I don't know, but I don't know any other way to go through this. I wanted to give enough examples so that you have a better idea of how to do this type of investing. I think it can add and be a huge advantage to you and build a lot of confidence and when to dive in when everyone else is getting out. All right. Let me know if you have any questions. Thanks.